Welcome back. Let's go across to Aditi Nayar. She's with us from ICRA. Aditi, we're looking now at back-ended data, and there have been sharp volatile moves, whether you talk about commodity, whether you talk about various currencies across the world, what central banks have done across the world. So do you think that, there would be an extreme sort of a slowdown as far as inflation is concerned? You think that is something which is the next thing to watch out for?
Thanks. In the Indian context, we have two different sort of triggers that we're looking at as far as our inflation readings are concerned. One, of course, we've got the global slowdown as far as the commodity prices, and this is very welcome because commodity prices had climbed to a level that seemed to be a little unsustainable with demand remaining, as it is, demand is quite uneven, but even maintaining it at those levels seemed to be a little out of touch with the kind of commodity prices that we were seeing. And that is something that we feel will come in very quickly into our Indian WPI inflation, a little more slowly into the CPI inflation, although what it's going to do is prevent further month-on-month increases in the Indian CPI from being very large. However, for the Indian CPI, there is a different risk that we're very watchful of, which is what kind of momentum we start seeing on the services side going ahead, because that is really where we expect the Indian demand to be stronger. So we think the services sector is going to lead the demand recovery in India, and that is something that is going to add to the momentum as far as the services inflation is concerned going ahead, and that is a reasonable part of our Indian CPI. So,
right. So that's the first thing. The second thing is, all of the rate hikes that have happened. Yeah. Yeah. So the second thing that I want to ask about, Aditi, is, what's really happening as far as global growth is concerned. We've seen significant rate hikes across the board as far as, global central bankers are concerned. You think if global growth comes down, India will not be insulated, even though the growth number may come in, it may be lower than what the consensus estimates right now are?
As far as Q1 is concerned, we believe that Indian GDP growth is going to be around 12.5% to 13%. We've got our own ICRA Business Activity Monitor, and that is showing us that on a low base of last year's second wave of COVID-19, for Q1, the YOY growth is around 24.5%. This is based on 16 high-frequency lead indicators for the non-agricultural sectors. But what we feel is that in Q1, there are two things which are going to be very important. Why the actual GDP growth is going to be much lower than this 24.5%. And one is that we had the impact of the heat wave on the Rabi output. And the second is that because of the commodity prices being so high, margin pressure was particularly acute in Q1. So we're pegging Q1 GDP growth at 12.5% to 13%. Looking ahead to, we are a lot more hopeful for similar reasons. One, service sector growth seems to be fairly strong in India. Secondly, the commodity price moderation is going to help reduce the pressure on margins. But of course, yes, the downside is that with global growth looking like it's going to be particularly weak, our exports outlook doesn't seem to be very strong right now. However, in any case, we were looking at FY23 being a year where domestic demand was going to outpace export demand. So that's something that anyways we've worked into our forecast.
Right. Just in terms of rural space, how would you see that, considering that most of the commodity prices were higher? How would you expect the rural spending to be? Monsoon is also now, playing a catch-up role. How do you expect that side of the market? Two-wheeler companies are suggesting a pretty strong growth in the rural market.
So for the rural side, there's a couple of conflicting things that we need to look at. One, of course, the monsoon has finally sort of caught up, the progress has improved. And with that, we have seen a catch up of the sowing as well. But we still remain a little, circumspect about two aspects. One is the availability of fertilizers. And the second is the availability of manpower, because we believe that a lot of people would have shifted back to urban-centric service sector jobs. So where we finally end up as far as sowing is concerned, we think we're going to be at best at par with last year, not higher than last year. And therefore, commodity prices and, the overall market prices for agricultural produce, that is going to play a crucial role in determining what kind of rural sentiment we have going ahead. So that's on the farm side. But on the non-farm side, I do believe that remittances would have restarted to the rural economy from the urban economy. And that's something that, again, is going to keep rural sentiment slightly on the upper side.
Right. Every time when we see such sort of rate hikes, such sort of currency depreciation, you tend to remember what happened in 2013 and how taper tantrum really had an issue on the overall growth perspective. What do you make of the current situation in terms of the Forex reserve, the NPA situation in the system, how banks are lending and how they are capitalized, how corporates are, leveraged or deleveraged? How would you look at the whole assessment and say that we are in a situation that if there is a storm, it could be better held this time around?
We do think so. I mean, certainly we have forex reserves which are much, much higher than what they were at the taper tantrum time. And even now, we are looking at the current account deficit being capped at around 3% of GDP. So while in absolute terms, that's about $105 billion, that's an all-time high. But comparatively, if you look at it as a percentage of GDP, it's much, much lower and much more manageable than what the situation was in 2013. So we're not really looking at a disorderly situation going ahead. The INR has depreciated, but much less than many other currencies. And the argument is that, we need to let the INR weaken in an orderly manner so that some amount of export competitiveness can be protected. And, perhaps there's a little bit of pain left ahead for the INR, but again, we don't see it as being a very substantial sort of down move. And, globally, right now, there's this flight to dollar assets, there's a flight to safety. Perhaps what we're going to end up seeing is a situation where rate hikes are aggressive, but they're front-loaded, and they end up sort of tapering off earlier than what the market is expecting. So it may not be as prolonged a rate hike cycle in the US as well as what was being expected earlier, given the fact that commodity prices have already corrected so much. So I think we really need to wait and watch next couple of months and see what kind of transmission the commodity price fall has on CPI readings across the world. And that will give us a better sense of how long the rate hike cycle is going to continue. And therefore, what kind of pain we can expect on the growth side and on the job side.
All right, Aditi, thanks so much for taking out time for us. Always good to get perspective from you. Thank you so much for joining us. On that note, we're completely out of time on the show, taking a break. Stay tuned. Lots more lined up on the other side as we speak. Nifty continues to be stable, up about 160, 170 points.